We are really focusing on this idea of portfolio resiliency, so looking at parts of the market that can either buffer the downside risks or offer uncorrelated returns. So hedge funds, real assets that can protect if we do see an inflationary surprise. We have liked gold, of course, that's rallied a lot. And then within equities, looking at taking exposure to the areas that we like or the companies that we like, but generally through structures that can generate yield or structures that offer downside protection. This backdrop of uncertainty does make it very hard to have high conviction on directional views.
So so in that case, if you don't have directional views, where are you looking to hide in this market? What are you telling clients, like in terms of an asset allocation strategy?
Mm-hmm. Yeah, so we still like the U.S., especially if you're taking a longer time horizon on the recent pullback, but more focused selectively on specific names that have pulled back that we like, structurally speaking. We still like Japan as well. So within Asia, we like Japan. Japan, while you can show the screen of all the Asian markets rallying, of course, we have seen a very strong year so far in Asian markets. Japan has somewhat lagged, and from a valuation perspective, it looks quite attractive. And that was, we've liked it really since the start of the year, and now you can see obviously the news with Warren Buffett and the rally that's sparking. But both on valuation and on earnings, we have really liked Japan. And within China as well, it's a very large market. The rally does bring valuations more or less back to fair value. So we're fairly neutral at the index level, but we definitely still see upside, specifically in some tech names and some AI beneficiaries. So it is about being a bit more selective. And as I mentioned, we like Japan from the index level. We still like the U.S. as well, but it's just about being selective and finding some of those spots that have pulled back.
How do you then reconcile what people are saying on earnings versus what people are saying on the economy?
Yeah, the economy is seeing a bit of a soft patch in terms of survey data. It's still not clear yet whether that survey data will follow through into weakness in hard data. And so we look across the board, whether you're looking at the weaker consumer data or still relatively strong kind of PMIs, it is still quite mixed. We do think that start of the year expectations were likely too high. Forecasts will have to come down a bit, but we think we're just seeing a bit of a soft patch in terms of survey data because of all the policy uncertainty that we're seeing. Once the dust settles around some of the policy uncertainty, and if survey data doesn't feed through into weaker hard data, you very well could see just continued resiliency. Not really outperformance relative to expectations, but continued resiliency within U.S. data. We think what we're seeing right now is just a bit of a short growth scare, but not going to translate into a recession.
Okay. We would talk about top conviction calls in the other segment because you stay on for another block. But I do want to get your sense in on gold as a preferred diversifier at a time when a lot of analysts are saying we've seen the top. I mean, 33,000, 3,200, max 3,500, which is actually quite a bit of upside from here. But 3,000, 3,200 for the near term is the headroom for gold.
Yeah, it's moved a lot. I think we see reasons why it could continue to go higher from here. I mean, one, it has been the best portfolio diversifier against geopolitical risk. So when you look at the performance of assets in periods of heightened geopolitical risk, gold tends to perform the best. As well, really, since the Russian invasion of Ukraine, you have seen gold detach from interest rates in terms of its relationship with real rates. And if we have rates moving lower, which we've seen in the 10-year, and our expectation is for the Fed's next move to be a cut, then you very well could expect gold to go higher as well as rates come down. And so when you look at it both as a portfolio diversifier, as well from a structural central bank buying perspective, and then with rates coming down, we see reasons why it could go higher. Of course, it's rallied a lot, so maybe the upside is a bit more limited than it was if thinking about it last year, but we still think it could go higher from here.